Let's bring in Lawrence Yoon with the National Association of Realtors. He is the chief economist. So, Lawrence, you have a little more interest in people renting, trying to buy a property, but less interest in people selling them. What changes this?
Well, we all know about the lock-in effect, but with each passing month, our realtors are indicating that some homeowners who thought that they would not list their property for a long, long period are now beginning to say, because of life-changing events, such as finding a new job in different part of the town or in different city, they have to give up their 3% rate and put the home on the market. Sometimes there's, marriages, divorce, death in the family, newborn, all these impacts, and cumulatively, with the passage of time, more life-changing events, therefore more need for residential address changes. So we are seeing more inventory coming onto the market, about 20%. So independent of the consumer survey, the actual reality is more inventories are showing up on the market, and that is beginning to excite some buyers, knowing that there are more choices out in the marketplace.
I see that anecdotally. Diana, what would you add?
Well, so I would say looking at your numbers, and Lawrence, I'd love for you to answer this one as well, is looking at the numbers, yes, inventory has come up, and especially we have new home inventory very high. But when you mix the two, you still have just about a 4-month supply of inventory on the market. You're going back to 2019 levels, and I remember in 2019 talking about how inventory was still low. So, yes, there's some more coming on the market, but it seems that buyers today, and I look at pending home sales, which are really based on signed contracts, so the most current indicator, pending sales have been falling since November, and mortgage rates really have moved within this 50 basis point range, so not that much. Do you think it is more consumer sentiment and concern about the economy that's going to pull people back, even if there is just that little bit more supply that you're talking about?
Certainly there are economic worries, certainly in the D.C. area with the DOGE impact on federal government employee job cuts. But the rest of the country is still adding jobs. And job condition is clearly an important confidence measure. Now, we have seen some decline in jobs in more discretionary spending, like in the leisure and hospitality, should maybe implying there could be some crack in the economy. But what we generally find that even if there is an economic recession with net job losses, I hope we don't get there, but let's say hypothetically there is an economic recession. If the interest rate decline, that tends to have more powerful impact for the housing market, home sales, because roughly 90% of the workforce would still have job and they would respond to a low interest rate environment. So let's see what the Federal Reserve indicate today about their rate cut decision in the future. Not today, but in the later months of this year. And with inflation possibly coming down, despite the tariff condition, if the inflation comes down because of deregulation policy or, say, more home construction as the federal land gets opened up for more development, maybe we will begin to see lower mortgage rates along with the Fed rate cut.
Do you think any of this macro or policy uncertainty, Lawrence, is keeping potential sellers or I don't know, buyers? Is it keeping people on the sidelines or no?
One thing that has raised interest is that real estate wealth, housing wealth is at an all-time high and still rising incrementally. So stock market is undergoing a wobble, volatility, and maybe people begin to focus to say, where is stability? Some people are turning towards gold, but maybe other people will turn the solid foundation of real estate where the mortgage default rate is still near historically low levels.